Good morning, everybody. Let's see, I'll try and hang out a few seconds. I see that there are some people still coming on to the webinar. Most everybody hears me okay? Very good. I got one of my main screens up today, so I'm actually buying stocks off the lows today, and one of the reasons is I think stocks are a different situation than perhaps the indexes. But one thing to take note of here is the NASDAQ, it seems to be moving in this choppy trend channel here, and so we ran up to the top 6 days ago, and of course you break to the downside. And that's a pretty steep drop, and it takes you right down. You know, you can draw this lower trend channel line wherever you want. You know, I can move it up a little bit. If I really want to make things look really scary, I could also do this. I could draw this and call this an ascending wedge. And oh my God, now it's broken support here. The market's in a tank. So, you know, a lot of this can mislead you. But I think the bottom line here is that we still tend to think you're in this choppy, nutty market. Now, the market direction model is essentially an objective system that has some minor discretionary components that try to keep it out of trouble. So that's going to give a signal, and we're not going to try and finesse the signal. The signal is what the signal is, and you decide how you're going to handle it. Now, knowing that the market has been very choppy, our approach in implementing the signal has been to take partial positions in an ETF and then seeing how the thing works out. Yesterday, you know, we're buying the quid under 34 on the signal, and you know, so far that has worked out short term. Now you're coming up to this trend line here, so we'll just see how this pans out. Meanwhile, you can see the market trying to rally up off the lows, and NASDAQ's getting hit the most, and I think that some of that is due to some of these big stock names like you know, Apple was taken off of somebody's we love this stock list or whatever they call their recommended list, and so it's down a hair. But notice how it's trying to get some support off of the 10-day line. So there's a little bit of this, a little bit of that. Some of the stocks I was looking at this morning, I think Facebook acts okay off the lows here. You know, you don't get a lot of selling yesterday. I thought that was interesting with the market getting whacked. It had very low selling ones. So off of these lows, I'm always willing to test a little position, see if it can bounce up. Now you're pushing up against the 10-day moving average, which is around 31.34, and see if you get through there. But at this point, you need to see volume higher than the volume you have here, which is about, what is that, 10 trading days ago? We're getting close there. What is that, Dr. K? 1, 2, 3, 4, 5. It's more, yeah, that's 10 days ago exactly. So that's 28 million shares, around 29 million shares, so that's a fair bit of volume. I don't know if it's going to get through that. But in the next few days, you're going to get past that date, and then you'll be looking at about 19.5 million here you would have to exceed for a pocket pivot. So, but, you know, all that's to say is who knows what's going to happen exactly. The market's a little choppy here, and you could be in the summer doldrums. Dr. K, what's your take on the market with respect to what's going on and the MDM?
Well, we're in a downtrend here, and so the MDM is watching and waiting. I mean, if we get, you know, this is a chop slop kind of market. So if we say get a concerted push to the downside that looks a bit oversold, the reversion to the mean will kick in, and the model actually may go to a neutral signal to capture those gains, as opposed to a more trending market where it would just sit on the trend.
Right. Okay, so you know what we could do here is possible you could test the 200-day moving average, but you're all kind of in this zone here, where I think once you're down 5 days in a row, it becomes a little bit obvious. The need to sell becomes a little bit obvious, and so that was my thinking last night, was that there's not a heck of a lot to do. I might step in and try and buy some stocks at support, but I wouldn't be trying to go short, since I think most of those have had some downside moves, like some of the stocks we talked about, Chipotle, VMware, F5, CRM, all those stocks have moved lower, Baidu as well, and they're still pretty weak today. So if you're short any of those, I think you can sit with those, because I think the market is a lot more like a bifurcated market rather than a sort of a consistent market where you have a lot of stocks acting well. You have some stocks that act okay and try to hang in there, and then you have some things that just act terribly, and I think you can be short the terrible stocks and long the better stocks if you want to try and pick them off. But I think you have to be active in this market. It's not a trend follower's market. It's more of a trader's market. So given the position of the index here, the NASDAQ at this trend line, whatever you want to call it, this lower trend channel, whatever, wherever you want to draw these, given that you're down at the low end here, probably I need to see it bust hard to think this thing is real weak. Otherwise, we could just be choppy here for a while. So, but right now, the MDM signal is producing small profits, looks like about 3% since yesterday's signal. Is that right now? More like about 1.5%. So not.
Well,
not
yeah,
huge.
you're talking about the Nasdaq composite.
Yeah, maybe the PNA and the other ones are acting a little bit different, but it's still a tough market, guys. So you got to kind of recognize that we're also in summertime. June follow-throughs tend not to work, and I'm not sure what you call this one. I guess it's all under pressure, but to me, I think it's a stock-by-stock situation. So let me go through. So all that is to say is, coming down here, we may be prone to some kind of bounce, but also a bounce that simply results or is consistent with the whipsaw nature of this whole move that we've seen since the lows of early June. So that's kind of what you're looking at, and you got to kind of keep that in mind. I think, last week we talked about keeping tight stops, and that's something that I like to do when I'm running positions. Somebody got a little bit confused on that, wondering, well, don't you use the 7-week rule? The 7-week rule is something that you use once the stock is up and out and starting to trend. In the short term, as I'm trying to come into positions and the market's trying to turn, I'm keeping an eye on two things, my stocks first and then the indexes, because if the indexes continue to get weak, eventually it's going to start to drag down your stocks. And if you're in heavy, the way I often am, with 50 to 80, sometimes bigger positions, I was actually short CMG the other day off that 8.4 level, and I was 180% short CMG. Covered it yesterday, and around 7.7, I think that was. What was that? Let me check this out. Yeah, around 3.77. So you make a little bit of money, a couple of percent, but what does that add up to if you're 180%, 3, 4, 5%? It's almost, to me, almost a joke. So on the short side, it may be a little bit overplayed here, and you're just going to chop and slap. So if you're trying to short, don't be too shy about taking profits if you get a 3, 4, 5% profit. I don't know if you're going to get. We usually like to see 15, 20% profits on the short position. I don't know if you're really going to get that here, but you can see some of these that we talked about the other day. VMware is trying to hang down here. But, the other thing to keep in mind, come on, get rid of this pencil. You're down. You gap down, and you come down for several days. So it wouldn't surprise me to see a reaction rally up towards the 10-day moving average. Last time we were looking for that in one little pass. So that's one that's actually working. Fossils also coming a little lower, but the same situation there. It's broken out to the downside, breaking out of this sort of reverse flag after the gap down. And so now you're prone, I think, to a rally up into the 10-day moving average. And that's kind of what I would be watching for to short that. CRM, the same thing. Salesforce coming down to this low, so just barely undercutting it, but broke down through the 200-day the other day when we were on it, and you've got a little bit of a move here, but how much? 4 or 5%. Whoop-de-doo. Is it something to get excited about? No. But can you bag it and then have your cash in your hot little hand ready to do something? I tend to prefer that way, especially in its choppy market. So that's kind of how we see the market with respect to the shorts, and you can see that Baidu as well is broken out of this flag. But I think you might be prone to some sort of reaction rally, and if I was interested in shorting again, I would watch for these rallies rather than trying to come in here. I think that would be almost fatal. You can see F5 continues to move lower as well after kind of breaking out rather to the downside from this reverse flag. So you have a move down, and then this is a reverse flag in here. Now you break out here, moving lower. So, are these things going to blow apart? If you're short them right now, you can wait and see how things go. Just give yourself a trailing stop to make sure that you get out of here with a profit, okay? Now, on the long side, we talked about Facebook, and I'm long the stock. We are actually long the stock right now. Coinstar also, another one I said to pick up off the lows today, and up on the stock down closer to 65.50, I think was the opening low. But you can see here, if you want to count this as, call this the top of the basin, to me this is more like a big zone. It can pull in anywhere in here. The pocket pivots were down in here. So to me this zone kind of becomes an area you can pull down into, and it does. And you come down 3 days in a row. Volume is not terribly heavy. There's a lot of short interest in this one. There's also the put-to-call ratio on Coinstar. Last I checked was about over 12. So somebody seems to think that this thing is in trouble, but a lot of people have hated Coinstar because of the fact that they've already announced that the acquisition of the NCR machines, video rental machines, is going to be detrimental to earnings this year, but it will be accretive next year. So that's kind of baked into the stock. So I think coming after the stock and shorting it when the story is already indicating that you're going to see a slowdown in earnings strikes me as a little bit of following the news more than anything. And I don't really see where necessarily this is in trouble, because their whole kiosk system is ready to expand into a number of areas, and that's still to be seen. In a way, it's sort of like Facebook. Facebook's coming out with earnings at the end of the month, but everybody knows there's nothing going to be nothing there too exciting that's going to be announced in terms of the earnings growth and whatnot. In fact, they're expecting contractions. But the real key is going to be what Facebook does in terms of monetizing their subscriber base, and they're moving forward on that very rapidly. So there's always a possibility the earnings announcement could also have some sort of news announcement regarding some sort of arrangement. They had they're partnering with Yahoo on some ad content and stuff like that. So who knows what's going to happen. I think the one thing going for Facebook, if I have people about Facebook, and I'll pretend I'm on Fox Business News telling them why I like Facebook, I think the fact that Apple has integrated a number of things into their operating system that use Facebook. I think having a vote of confidence from Apple is positive, and so you have to keep that in mind. And it is a big stock, so if the market's able to hold up and turn here, I think you'll see the stock rally back up. And if it broke out, you might want to be a buyer here. I'm not sure how you feel about buying into earnings, but my suggestion always, when in doubt, if you get a buy signal on a stock and you want to buy, go into earnings, buy a 10% position, because if it does blow up 20% or 25%, it's going to be 2.5% to your portfolio. I think that's very tolerable, but that's only if you feel like you want to do that. It's not like you have to to be in the market trying to force things if you're not comfortable. But if you want to do that, that's what I would suggest. For myself, I might go in 25, thinking that if it does drop 20%, that's 5% of my portfolio. To me, that's just a nick. I know a lot of people freak out if their portfolio drops 5%. To me, that's just a nick. And Dr. K, that's kind of the same way you feel, correct?
Yeah, that's exactly right. There was a question actually about those who are using their IRAs with the MDM, and so this is not related to stocks, but they wanted to know, they have trouble, the funds take 3 days to settle, and so if the model switches rapidly, what do they do? And my suggestion was you can trade half your IRA, so you don't have to wait in the event of MDM signal switch. Otherwise, you could pyramid in if you're buying late relative to when the model did switch the signal. And so if the market has risen X% above when the signal was issued, you could pyramid so you won't get the full performance percentage from that time you're buying it, but it will mitigate losses if the market at some point heads in the opposite direction of the signal.
Yeah, but here's an even simpler solution than that. And this is the one that we implement in the VMAPs, or the Managed Account Program, where we buy the ETFs. And in retirement accounts, what we'll do is use 2x or 3x ETFs. So, for example, if we want 100% exposure to the market in an IRA account, we will use a 33% position in a 3x ETF. So that essentially gets us to 100% market exposure, but we're using a 3x ETF and only using up a third of the cash. So check with your broker on how they apply your cash to those ETFs, but I believe it is a cash-to-cash basis. And so you would be able to get your exposure using a leveraged ETF. That's one way to do it, but check with your broker to make sure they don't have any weird or special cash requirements for those. So we've noticed that with TD Ameritrade, there's no issue with that, so we can actually take 100% exposure, as we will do in the Virtue of Self-Investing Managed Accounts Program Strategy A, which maxes out at 100% exposure to the market. We can do that, and we have been doing that so far successfully in terms of being able to use the cash without getting ourselves strapped if we have to do a couple of quick trades back and forth. And if the market does turn, we may end up doing that, since we did take a QID position yesterday at about 33.90, and it's up a little bit today, as you can see, but we'll see what happens here as this progresses. And like Dr. K said, you might get some reversion to the mean neutral signal on the MDM. But that's a way to deal with it in your IRAs if that's the problem that you have. So we were looking at coins there, so I think that was testable. I mean, already I'm up on these positions, knock wood, and they're turning. I also like this Seattle Genetics, who actually stepped in and bought some just up above the 24 level as it's coming in. And I think one of the things I will look for as the market's coming down, and I just noticed something that happens, is that you look for something breaking what might be perceived as support. So over here, I see this thing coming down, through here, and I'm watching it for a turn. And of course, on the intraday, on the 5-minute, you can see the turn occur, and you get all my little moving averages are turning back to the upside. But usually what you'll see happening is you'll see a bottom, and then this thing will move up, and this is with any stock, and then it might go tight sideways or it might retest, and on that retest I want to see less volume intraday on the retest of the prior low, or I want to see the thing hold up and the volume drop on the sell side, and you can kind of see that happening. So it's starting to move higher, and there's about 21 days of short interest in this. We talked about this before. So I tend to think this market is one for opportunistic trading, and that's the way I approach it myself. I don't buy into strength, and I don't necessarily want to sell into weakness. I prefer to be out of weakness a lot quicker. And I want to show you guys something, and hopefully it doesn't confuse everybody. But how do I handle, say, a Mellanox, which is a nutty stock, really, and it's very volatile. I mean, it has that sort of character. So number one, what kind of animal you're dealing with here. You know that you're dealing with a volatile stock, and it's a little bit thinner. I think it only trades about 600,000 to 700,000 shares a day, and so you have to know that. So understand the stock you're dealing with, okay, and understand, as I say, the animal that you're dealing with and trying to tame here. So when it's holding up, I want to always see this thing holding a prior breakout level. So if I'm getting in here, I don't ever want to see it drop below the highs here where I'm starting to buy along this 10-day moving average. It never does, and the pullbacks actually become viable. Now, as it runs up again here, you're breaking out of a little pattern here. I would think that it should hold this 70-71 area, and when it started to flop below the 10-day moving average, I actually blew my position out. And for those of you who are in the VMAP C strategy, which is the stock strategy, you'll note that we did blow that stock out somewhere around 71 and change, and so we blew out of that very quickly. Because A, we know we're dealing with a volatile stock that can come down very quickly, so we're not going to let ourselves get in trouble. And the thinking is that if it was acting so strongly with nice upside volume on this particular day here, let me get out my little, acting well on this day and moving to highs, it should have held that, I think, pretty well. And when it doesn't, we kind of just back out very quickly. But you notice now it comes down to the 50-day moving average. That provides you with a very ready downside stop, and you can step in and buy. And again, my approach to this market has been to buy weakness and sell into strength, okay? Or at least if I see strength in my stocks, I want them to continue exhibiting strength, and once they start to wobble, I'm just gone. And I don't mind buying back because I like to use the liquidity of the markets in my favor or to my advantage. And I think in this sort of market, that's kind of what you have to do. Now, if you're not the type of person who has a psychology to be very active in the market and you want to be trading stocks and having to buy weakness, which sometimes you got to bite the bullet or just kind of step in when it may not look like you want to. If you're not able to do that, you don't have a ready system for blowing things out quickly. In other words, being able to accept a 1 or 2% loss very quickly and get out with the idea that you might have to come back in later, then don't do it. Wait in cash. No problem. The cash is fine. Ross Haber has our Strategy C program in cash right now, and as far as he's concerned, cash is king right here, unless you really want to get down and dirty and start trading around. And it's not necessarily clear that that provides any real benefit in a trendless market or an otherwise trendless market. So, as Ross likes to say, you can't get hurt, you can't lose money. So if you're in cash, and that's true, unless the dollar devalues 30% overnight, but that's another issue. But in any case, you can see some of these things are starting to move higher. Now, going through, let's look at LinkedIn. LinkedIn violated the 50-day moving average. You can see this barely close under, and then you move lower. Now, Dr. K, in your view, is that an actual violation, or is this close a little bit too close to really call it a close under the 50-day?
Well, generally you want to see it close under in terms of, it closed at 102.98, the 50 days at 103.46. So, that's kind of a judgment call. I would say that would be a violation, but just barely. just barely a violation. And keep in
Yeah.
mind that it's trading in a basing formation as well. So and I would call that a violation, but it's the 50-day. It's moving sideways seemingly in a basing formation, so it's going to violate that 50-day number of times.
Yeah, and here's your big base. So and this may be a new base in here or whatever, but I was also saying it could turn into a punch bowl of death formation. But that's all depends on the market. You can see the market's trying to turn right here. So I would think that we might see things turn green here. And let me remind you something else. Those of you who are using the market direction model with ETFs, you don't have to sit there either and wait for the model to change signal. If you're uncomfortable, set tight stops for your ETFs, and also run positions where if it moves in your favor 2-3%, you maybe cut out half and then let the rest ride, because I think you're still in that sort of bizarre choppy environment. I think today's action right now, at least at 8:51 Pacific time, a little over 2 hours into the trading day, seems to be the case. So one thing I didn't like about LinkedIn, it was moving higher towards the 110 level, and you notice you're not getting a lot of volume down here. So it's telling you it's kind of just inching up on no volume. You weren't getting much selling either. Excuse me. But it did pick up here, and then you violated the 50-day. In my book, this is too iffy for me to want to play. I would rather play Facebook, I think. And Facebook has announced that they're putting out a job site, and they may actually be better leverage to do that. So we'll see how that goes. But I think that a lot of analysts defending LinkedIn say, oh, that's not going to be a problem. I would beg to differ. I think if Facebook made a concerted effort, they could provide a real pinch to LinkedIn's business. So I won't operate on any assumptions that the stock is okay, because it did sell off 3 days ago on that news, or maybe it was 4 days ago, one or the other. But in any case, it sold off on that news over a couple days. And just watch the action. If the action tells me to sell it, I sell it. I'm not going to sit there and go, oh, well, Facebook's not really going to be able to impact LinkedIn. Forget that, the alibis or whatever. Just stick to technical rules, and I think you'll be fine. And let's see, coins that we looked at. I noticed, housing stocks have acted well, and Eagle Materials still seems to hold in okay. The one thing about this one that I like is that you had a viable gap up, and despite all the selling over the last 5 days, stock's actually held in pretty well. It's a little bit of a thinner stock, trades about 623,000 shares a day, but I still like the way that's acting. Another one I noticed was acting pretty well the other day was this A Biomed, and you actually had a little pocket pivot here just off the 10-day moving average. Today pulls back a little bit and still holding the 10-day moving average. So that's okay. Let's see. Monster, we talked about that. It's dipping below the 50-day moving average, but interestingly enough, still has not violated the 50-day moving average. Notice, though, it tries to hold a 65-day exponential. So in my mind, I think the two moving averages create this sort of zone in here that stock can move into and find support. It's still, I think now we're in the 4th week of a base here, and it still may just need to go sideways for a little bit of time. But I think this one looks okay. I'd keep an eye on it if you want to try going long at some point. Again, last week we talked about Equix, but I mentioned the fact that this is mostly a REIT story. Now the company's owning a bunch of data centers. I don't know what it's, 60-something, I think, or some other number. And it's not really kind of my cup of tea, so I would just blow it off. I tend to like Mellanox if I want to be in new cloud names, but you'll notice a lot of the old cloud names, VMware, F5, CRM, even Rax, all have just been pummeled and have not really participated in the market's bounce since early June. Riverbed's another one that was a big winner a long time ago, and look at that thing. So it seems like old cloud is out, maybe new cloud is in, and maybe Mellanox folds in. This is almost too classic going into earnings. I think in a couple of weeks, they bring it down and then it'll gap out on earnings perhaps. But I might be willing to hold. If I'm buying here off the 50-day and it's able to move back up into the 70 zone, I might be willing to hold a 20% position into earnings. Okay, now that's risky. Okay, but you just got to do the math. How much do you want to lose if it doesn't work out? How much are you willing to lose? Always think about that. And I think people don't ever really think about it. I got to tell you guys something. As much as I love to give Dr. K a bad time about his model, okay, the reality is, go read Michael Covel's book, The Little Book of Trading, Trend-Following Methods or Systems for Big Winnings. I think that's the title. But in fact, I talked to Michael on Tuesday. He actually did a podcast interview with me, and I'm not sure when that's coming out, but he's been editing, I suppose. But in any case, just people like we have one guy who gets all upset he's down 11 or 14% or something like that, and your model is terrible. Blah. Well, you know what? If you're investing using the market direction model, you better understand one thing first, and that is it's a trend-following model. And if you start to cherry pick the signals, or you think that a 10 or 15% drawdown is a terrible, awful thing in the model, and Dr. K are evil, disgusting, vile creatures, then I think you have your head up where the sun doesn't shine, and you don't really understand what you're doing. You're expecting that because Dr. K and I both have this background working for Bill O'Neill that somehow everything we touch turns to gold, and that's about as far from the truth as possible. And I can tell you just 2 out of 3 things that I touch generally turn to mud. So but I'm always working towards that thing that turns to gold, and that happens from time to time. And I'm kind of watching my stocks rally today. I've got these 4 positions, so you guys can all know that. Not sure if I'll hold them all day. It depends on how everything pans out, but I'm in nice spot right here, so we'll see how this goes. Let's see. NSM, there's talk with QE3 that there's going to be probably more mortgage-backed securities type stuff, and that might be what QE3 is. And so I guess this has had been some factor in these mortgage servicing companies. But this thing has a huge run, and it's just hanging in there. And notice that despite the sell-off, this thing has held its gains really well. Now, if I own a big stock, or not a big stock, but a big winner, a stock that's doing very well for me, this is what I want it to do. Okay, I don't really want to see something come flying back in. This is pretty good strength, and I'm impressed with this for such a thin stock, relatively thin stock, having such a huge move off a tight flag formation, holding tight. That's impressive, I must say. So, a couple of things that bother me. Big stock, Intuitive Surgical, you got a pocket pivot here, and then you blow the 50-day here. So either it's going to base more or whatnot, but it tells me I don't want to buy it, so that's not something I want to own. Apple, again, it's coming back, trying to push back above the 600 level. This could just turn out to be a buying opportunity, people. So stock held up very well over the last several days with the market coming down, and what I think is with the market blown apart, generally you got Apple in there blown apart and causing the market to blow apart and come down. And this time around, it really isn't. It's actually been doing that ever since mid-May, roughly. It's been counter-trending the market. And every time the market has moved down, it's actually held up better and made a higher low, followed by a higher high. And so I think this is actually showing some interesting strength. Now, the key is, are you going to hold it into earnings? And again, I think you get back to this whole idea of, okay, let's say you bought, 25% position on the pocket pivot, and it's run up for you, 4 or 5%. You could cut it in half to 10 and sit through earnings. If it drops 50% in half, you're going to lose 5%. Okay, big deal. So I think, but in 50% is a pretty extreme drop, and I don't think you're going to see Apple drop. I was in the Apple store a couple of weeks ago buying my daughter a Apple. What is it called? Mac Air, which is quite an amazing laptop. It's so thin. It's paper thin. And I had to go buy myself a new iPad 3 just to console myself for not getting one myself. But I still have to blow up a few more PCs before I can get to a Mac. Get around to buying a Mac. And when I buy a Mac, it's probably going to be the top in Apple. But that may not be for another year. But in any case, I'm in the store, and that place is packed. And you go in, and they ask you, what, hello, blah. They have greeters, and the greeters are not 67-year-old retired people. They're actually young people. And everyone's very enthusiastic, and they set you at a spot on these tables where they have all the products all laid out for everybody to play with. And then it took them about 4 minutes before somebody came over and helped us, and very helpful, and we got exactly what we want. We liked the price. I thought it was pretty decent. So, what is that?
Fire alarm apparently is going off.
Interesting. A London car alarm?
No, fire alarm.
Oh.
Fire
in the
alarm.
building?
Yeah, that's odd.
Does that mean you got to run for it, Dr. K?
Possibly. Let's just wait to see.
Well, if you do, just go ahead, and I'll carry on here. So just don't get yourself burned up there, buddy.
Yeah, I'll try not to.
So anyways, I wouldn't count Apple out. So if I'm up on a position, I might be willing to hold 10% or 20%, So depending on what you're willing to lose. And I think, people need to think about the downside in any strategy that they're doing, whether it's using the market direction model or buying a stock and holding it into earnings. Consider the downside, consider how much you're willing to lose, and when it reaches the maximum you're willing to lose, you are stopped out. And that's the bottom line, and I don't want to hear, no whining after that. It's just the way it works. Here's a question for you, Dr. K. You still there?
Yeah. I'll
let
cough
me know.
the smoke.
What?
Nothing. It's fine.
Okay. A little excitement here, so... anyways, somebody says, I didn't see the sell signal yesterday until after the market closed. This morning the market opened down 20 on NASDAQ, so I didn't buy on open, and now it is worse. Should I buy on the open, and what do you recommend now? Any words of wisdom there, Dr. K?
It's like I said earlier, if you missed the signal and you've missed it by X%, take that into account, and if you want to pyramid in slowly, you can. I wouldn't go in whole hog, just knowing that you're putting up that much more risk. Now, if the market, say, retraces back, if the model's still on a sell signal and the market has a rally, and such that now you're, say, within less than 1% of the signal, or whatever that percentage is, that's within your risk tolerance zone, then you might go in with a full position at that point, knowing that your risk is only X% greater than had you acted when the signal was initially triggered.
Okay, I think that makes sense. Let's see, I'm going to go through some, well, you guys know what I like, and, so I bought them this morning, they're all up. I'm actually up close to 3% on the day. Woohoo, let's party. And we'll just see how it pans out. But I'm ready to blow out of them very quickly if the market doesn't work out and it starts to roll over again. So so just be advised if you think that you're going to buy what I already bought, a point or more lower in most cases, and make money today. So do your own work. Let's see. Let's go. What is your rule of thumb for how far off the 10-day you are willing to buy? It really depends on the stock, but if it's a pocket pivot, you'd like to buy as close to the 10-day as possible. And just remember, it's not a matter of how high are you willing, as if that, you have to have some sort of, you got to be a floozy, it's like, oh, I don't care if I'm buying at 5% beyond the 10-day, that's how much I'm in. It's really more a matter of the math. The higher you buy away from the 10-day moving average on a pocket pivot means the higher your risk, okay? So you have to take that into account, and you scale your position and set your stops accordingly. So, how high I'm willing to buy up off the 10-day depends on how much momentum I think the stock has moving off the 10-day, but that's that's sort of a judgment call, a tape reading call, and I don't think a lot of people are able to really do that, or even to move out very quickly if it doesn't work out. So it's really more a matter how much risk are you willing to accept buying a stock in a position that is extended from the 10-day moving average. Simple concept. So get everything back. Go ahead, Dr. K.
It's also relative to the overall chart pattern. So if it's a very volatile chart pattern, then it has that buying above the 10-day by a certain percentage has to be taken in context with the overall chart pattern. So you can't really apply like a hard percentage and say, oh, well, it's 3%. Every time it's 3% off the 10-day, I'm not going to buy it, because what if the stock is very volatile and it happens to be 3% above the 10-day, but in context of the chart, it's still within viable zone. Now, you have to ask yourself, maybe that stock is too volatile for your risk tolerance, in which case just don't even trade the stock. But if it is still within your risk tolerance level, then that 3% may be permissible relative to the overall pattern. Whereas a slower pattern, that 3% might be very, very out of line and very extended relative to the slow-moving stock.
That's a good advice, I think. Let's see.
Oh, one other thing I just came to mind. Let's say you had a move off the 10-day, and we've given some examples in our presentations of this. So you have a big move off the 10-day. Let's say it closes 5% above the 10-day, but the low of the bar was right at the 10-day. That 5%, you might decide. Let's say that 5% is within context of the chart as not being extended, and let's say that 5% is permissible within your risk tolerance level. Let's say the next day it trades right at that close. Well, technically it's still, the next day then it's 5% above the 10-day, but of course it's still buyable because it's still within the buy zone. So, you have to take that into account as well, not just look at the 10-day.
Okay. A couple of stocks people are asking about. We talked about NSM. I think that's, like I said, I think it's holding up really well. Qcore, Qcore to me, this is the type of thing that you want to pull your hair out on. But there's a couple of things I think that point out why, if you're trading a stock and you got a big move like this and it just starts to reverse like that and the volume's getting heavy. And I know this thing was coming in, down into like 54, 53, and the volume 3 days ago was a lot higher than the up volume 4 days ago. And in my mind, I wasn't long the stock. I don't think, Dr. you didn't have that one, did you?
No, I didn't.
No, so if I had been long the stock, though, if this big move is reversing completely and the volume is heavier than the prior day, I'm gone. You could wait around and see if it holds a 10-day, but this thing was acting so strong up until this point. And I saw somebody sent something about some analyst firm or something saying that the IBD method, the IBD 50 methodology doesn't take into account business sustainability and blah blah blah. And I just thought that was kind of a moronic statement from the analysts. They don't really understand what the IBD 50 is. It's actually a list of the best performing stocks in the market. And if you're in a whipsaw market, the stocks that move to the top of that list in a whipsaw market, that's maybe where they're starting to get to a point where they may pull back. So, the IBD 50 had that stock on there back here when we were first putting it up here on our pocket pivots or buying it and actually putting out alerts on it. Okay, so the IBD 50 was early on the stock, and just because it reversed here, these guys are trying to say, that the IBD 50 methodology, which they don't even know what they're talking about. They're talking out their left nostril when they start with that, because it's just a list of high relative strength stocks. You then have to figure out how to handle them based on the price volume action. And I would argue that nobody needs to get in there and intellectualize about the sustainability of a business model, because the market's action, the stock's action rather, the stock's price and volume action will tell you everything you need to know about the sustainability of that model. And I've owned stocks in the past. I remember when Apple had the iPod back in 2004 when I was making a ton of money on that stock. And there was all these naysayers. Well, this is sustainable. It's just an MP3 player, and Microsoft's coming out with the Zune. And anybody seen a Zune? What happened to those? They kind of disappeared. So you get a lot of BS about whether something is sustainable or whether somebody can, there's easy, no barriers to entry, and someone else like Microsoft can come in and make a Zune and take on Apple. BS. Watch the price volume of the stock. So any premise that somebody can tell you what a stock is going to do based on their intellectualization and rationalization of the sustainability the model is talking out, you know what. And so that's what I think of that. I just think that on this one, the way you would handle this is if you're seeing a strong move and it's reversing and the volume is already, so what I'm saying here is I saw this thing around 53, 54, and I noticed that the volume 3 days ago was already heavier than the volume on the big up move. That's telling me something is wrong, and I would just be gone. And so watch your stocks. If that sort of thing happens, you're gone. Now, that doesn't mean they won't turn around and go back up, but when something starts doing that and you got a profit, two in the hands, one in the hand is worth two in the bush. That's all I have to say. So,
yeah, we sent out a report on Qcore on this very point on July 10th.
Yeah, so I'm just kind of reiterating that. SYNC, again, somebody's asking about, you had a pocket pivot in here, but it's a choppy stock, so is it really doing anything that's unusual? When the market gets hit, usually the choppy, thin stocks, and it's only a $15 stock, so it's a thin little stock. I always just blow these off. I don't mess with thin little stocks. And I remember when I first went to go work for Bill O'Neill on 97, I loved like $16, $17, $18 stocks, and he really got on my case for that. And
both our cases, actually.
Both are, okay, so you got on your case too?
Well, remember, I like those young, thin things. Those little stocks that are just, to me, that's where the biggest growth potential is going to be back then. And there were some great stocks back then.
In the mid-90s, there were a number of stocks.
I would go head-to-head against him on that point. And I would, when I started making money off some of these names back then, then he had to acquiesce to some extent. Although
Yeah.
I respect that he's dealing with a hell of a lot more money, and so for someone like him, he can't be diddling around with the thin stocks. It's just not going to work.
No.
But for me, a young company is the best blood out there if you have the luxury to play them in the right market environment. Back then was the right market environment. The last few years have been the wrong market environment for these types of names. I mean, if they're young, they better have a great story behind them, and they better be pretty liquid. Otherwise, I won't touch them.
Yeah, and this one, it trades $1 million too. That's reasonably liquid, but the nature of the stock, this is volatile, and so it really doesn't violate. Here's your close below the 10-day, and it never moves below the low of this day yesterday. So you're coming back up. So it never really violated it. So if you bought the pocket pivot, you're trying to hang in there, you'd still be in. But I got to tell you, with the market acting the way it did 3 days ago on Tuesday, I think it was, yeah. I would have just been gone and out of this thing. The way this big gap up, I would have thought it would have moved higher, and it looks like a lot of retail buying, I think, coming in right here, and then the thing just reverses on big volume. So, if you're riding this thing, it's probably going to be like this. But one thing to notice here is this could be, okay, you see move to highs, one pullback. Move to highs, second pullback. Move to highs, third pullback. This could be an ascending base. So if you wanted to play this one and you're willing to deal with the volatility, then watch for a sort of a ascending base type of move here. So maybe we should look at, let me look at give me a second here. I'm going to pull up a weekly chart. My style templates here. There we go. And this one is, whoops, what happened there? Okay. Weekly. Bingo. So I don't know. What's your take on this one, Dr. K? Is this, whoops, where do you go? Where do you go? Oh, I know what happened. These guys are floating, so I need to unfloat them. There we go. And you can see here, one pullback, two pullbacks. Let's see, how does this look? Okay, one pullback, two pullbacks, and I don't know, is this a third? On the weekly, it doesn't so much look like that, but it is kind of an ascending base. These guys have technology that allows content providers like a cable TV company to put their stuff up on the web, I guess. And apparently there is competition, but you'd guess that from the way the stock's acting, it must not be that bad, because the thing didn't really blow apart. And the one good thing about this, I would have to say, given the action in the market 3 days ago, and yesterday as well, is that it did not really blow up. I mean, I would consider this pullback consistent with the way it acts. So, it's a riskier name. It can give you a lot of excitement, when it's working. It can be a headache when it's not. But, understand the nature and understand the pattern that it might be forming. And the fact also that it has almost, from here, from this $6 level when it broke out of this IPO U-turn pattern here, it's pretty much tripled. So, I guess Bill O'Neill had I heard about this from several people. He had a webinar or something last night, and Bill O'Neill, someone said last night it might be 6 to 18 months until we get out of this secular bear trend of 12 years. A secular bear trend is just a long-term market trend, and I think, if we look at the NASDAQ, for example, and this is just going to be, let's just go to a monthly chart of the NASDAQ. The 2000s, if you look at the 90s, these are the 90s. 90s were a beautiful parabolic market. That is a secular bull market. In other words, long-term bull market. And then we get into a secular bear trend, which is this, where you're just going sideways for a period of time. And it's very similar to the 1970s. When you came out of the 1970s, you had been going sideways and chopping back and forth for a period of time. So, another 6 to 18 months, it could be like coming out in the 80s and you have a brand new bull market. It's a possibility. I mean, I think you could start one at any time. So I'm not inclined to say when that's going to happen, but I just watch the market. But I do think you are, in 6 to, how many months was that again? 6 to 18 months. Oh, wow, Bill's really hedging himself on that one. 6 to 18 months, that's a huge window of time. So, yeah, anytime 6 months from now and then a year after that, we'll probably have the beginning of a new bull market. I would say even in a sideways secular bear, okay, like we're in right now, you could have a rally here without starting a new secular bull market, and you could have a rally that could still be significant and take you to the top of the range or something. But
Yeah, these
I'm not so
secular
sure.
markets last for many years, so 6 to 18 months might be an underestimate of a the secular bear that we're in could go for another few years easily.
Yeah.
And within the secular bear, you get these bull markets where you can make profits on leading stocks clearly, and because certainly in 2003 was a wild bonanza. There were parts of 2005 and 2006 where there was ample profits to be made on the long side in the right stocks.
Yeah, so somebody asked, in markets like this, do you guys mostly day trade? No, I short-term trade mostly, swing trading primarily, and I have a system I use for that. And no, I'm not going to show it to everybody because it is my own system and it makes me money, and I don't need to be giving signals out to a bunch of people all the time, since it is a short-term system. And if the market direction model was a swing trading system, that would probably be a pain in the butt too, because you're putting alerts out all the time as you're swinging back and forth. And so I use a short-term system that I implement in markets like this, and it's actually been pretty effective in the last couple of months, I have to say, since we've been chopping and slopping around in this upside trend channel that we've seen. So yeah, but it's not something. A lot of the systems I use for that are things I develop, and they're my own, and I know how to use them. And Dr. K has some of those as well, and we work together on some of those at times. So
yeah, I think the problem is with these, they're short term, and you have to be on the button right away when the signal switches. And if you're late, even by like a couple minutes, it'll throw it'll throw it out of whack, because I've actually done a study on
That's true.
Based on slippage. And so if you have time slippage of say a minute or two, that could cost you say 0.3 or 0.4%, especially if you're dealing with a volatile instrument. So 0.3% might not seem like a lot in terms of slippage, but if you do that over the course of 50 to 100 trades, it can absolutely kill a strategy.
Well, or at least make it more difficult. I would say, though, that's mainly dealing with some of these more volatile 2x, 3x ETFs. I think stocks, a little bit slower. I mean, I'm using my system today to be long SGen, and it gave me plenty of time to get in, and it's working well. It's almost unch now, down 2 cents. So moving on. I hope you guys aren't all in there buying it. Here, I'll sell it to you. Anybody want my shares? Let's see. ULTA. Where are we at? This is a weekly chart. What is this? A month? Oh wait, I gotta get back to reality here. Give me a daily chart. There we go. I told you guys last week I didn't care much for ULTA. It's choppy, and as Dr. K said, it violated the gap up low, and so retail stocks, some have done okay. Some of these specialty retailers getting pounded, so I'm not really a fan of ULTA. I know that Mellanox has earnings next week. How much of a profit do you need to have to hold into earnings? You must have a 12.876% profit to hold into earnings. No, just go back to what I said before. You think about if you hold a stock, no matter where you bought it, and it's going into earnings, think about the size of the position and how much it could drop on a bad earnings report and what the loss would be. So 10% position, you drop 50% on the stock after earnings, you're going to lose 5% net to your portfolio. So if you can handle that, which I can, that's how you would do it. Not necessarily saying, well, I need to have a profit cushion. It's always a matter of measuring the downside in terms of total damage to your portfolio based on the position size. And that's really how we handle it. But a good question. We talked about SYNC. Everybody wants to know about SYNC. Would you say that this year has been the toughest year of your career? No, for me the toughest year of my career was 2009. So actually I'm doing okay this year in terms of trading stocks, but I have to be very active. In terms of our market direction model systems, last year we were up 24%. This year it's kind of been the opposite. And so any of you in the VMAP program complaining because you're down 10 or 11%, to me it seems like a move to me. But no, I've seen tougher years. You just got to kind of figure it out or just blow it off. TFM, what is TFM? Oh, fresh market, right? Yeah, I don't. This stock acts okay. It's a little bit on the thin side for me, but it acts okay. I'm not a big fan of it. So, any comments on this, Dr. K?
Yeah, it's a retailer. It's got good fundamentals. It had a gap up. It's choppy. It violates it's violated the 50-day number of times, so that makes me like it a whole lot less. But the fundamentals are very strong on this name. And if it were to say come back around and break out of this sideways consolidation on some good volume, I might get more interested.
Okay. So you kind of like the name. And on a weekly chart, just forming a little cup with a handle here, so you're in a handle. That's about it. So you might watch for some kind of pocket pivot coming off the 10-day if you have a position from lower and you want to add to it. So that's one approach. Let's see. I thought somebody made some interesting comments here. Quarterly chart he showed. He's talking about Bill O'Neill's presentation last night. Quarterly chart he showed. It had a secular bear for about 13 years. That's why he's basically basing it on precedent, but I wouldn't say just because the prior secular bear market was 12 or 13 years, this one needs to be the same. It could be 10. So, but I think Bill's just trying to keep people optimistic. You don't sell newspapers in bear markets, and so I think I'm saying that you better be on top of things in the next 6 to 18 months. You could have a big bull market. I think he's absolutely right, and but I don't think he needs, for marketing purposes, maybe you got to keep people interested in the paper. I personally think everybody should be taking the paper, or at least having some market analytics system. The new MarketSmith, or we use Wanda, or High Growth Stock Investor, any sort of thing to continue tracking the market, even if it may be a period that's difficult, like we've been in, because there will be a new bull market at some point. And you should always be scanning the market. I mean, I can't think of a better way. Let's say if you're just fed up with the market and you don't think there's going to be another great bull market for another 6 to 18 months, then shut off all your other systems and just get the paper, because the paper will definitely keep you in touch with what's going on with the market and the leading stocks. So it's a great tool. I still read the paper. I don't know if you do, Dr. K, but I still read it every night. And for me, I get on my iPad, and for me, it's just a great overview of what happened in the market and all the strong-acting names. Even though I run all my screens, it just makes sure I kind of view it as sort of a mopping-up procedure at the end of the day, in the evening, to go through IBD and just read it. Mainly because I'm a junkie for charts. So I just love looking at all the charts, for one thing. But it does keep you in touch with what's going on in a very effective way.
Whether you get the paper or you do EIBD, they're good. It's a good read. There's lots of interesting articles outside of the market. I mean, it's a good paper. I've always said I love the paper, and so I still have my subscription, and I still read it. And I just want to make a comment on the secular bear. A lot of people would argue the last secular bear was from 1966 to 1982, so that is 16 years, 17-year period. And so if you're going by by the length of secular bears, from 2000 plus 16 or 17 years, that would put us at 2016. So if we're still a ways away if we want to compare it to back then. But of course, times are completely different now compared to back then. So it doesn't make really any sense to ever say, well, these secular bears were this long, therefore this one has to be this long.
Yeah, and my view is when the market's not looking like it's investable, I think you want to have the paper there just so you're aware of when it starts to improve. There's a bunch of questions about a bunch of different stuff, but I'm going to pull a couple of these. Someone's asking about PMT. PennyMac, that's another one. I would have to say, if I'm into this mortgage thing, I like NSM the best of any of these. So I have noticed, though, that some of these other REITs, they've been acting well. Simon Property Group is one that's building a cup and handle. It actually held in really well over the last few days as the market came in. So the whole area, and I even think, let's look at Ryland, holding in very well after a breakout here. So housing is acting well, and I don't like this one so much, but housing's acting okay, and this mortgage thing is acting okay. So I think these are all look fine. Gil and Dr. K, I'll let you answer this, Dr. K. With the fiscal crisis pending come January 1st and do nothing Congress not forestalling a potential crisis, do you see the markets blowing up in the fourth quarter or prior? That's an easy one to answer.
Well, you just look at the price volume action. Don't worry about impending news or news on the horizon, because that just creates often that wall of worry that the market relishes and will actually climb higher, defying all expectations.
Yeah, so we don't have to worry about whether we think the market's going to blow up. I actually think if the market sees a change in government, or at least forget about a change in government, a change in policy, because I think if Obama came out yesterday and started talking more in terms of deregulating, lowering taxes, which would actually, in my view, increase tax revenues. You hear these guys constantly, and this is why I think the guy's not that smart. He just constantly refers to raising taxes. And then when it was pointed out to him by ABC's Charles Gibson that history shows that raising tax rates does not raise tax revenues. He said, well, yeah, I know that, but I just want to raise taxes out of a fairness issue. That's a pile of crap, too. But to me, that just shows the guy doesn't get it. But I do think even if Obama tomorrow said, you know, I think we need to lower taxes, and I think we got to stop all these regulations, and we need to be drilling for more oil, and we need to emphasize natural gas. You know, that's one thing I don't understand is why they're trying to block shale production of natural gas, because even if you want to argue global warming science, and I know people on all sides of this issue, you know, we can all just kind of dispense with the argument, and why don't we just start using more natural gas? There was a great article in IBD overnight, or in today's paper, I think, about natural gas. Why don't we just use that? You know, then we don't have to argue about whether global warming is real. We're already taking a major step towards decreasing the amount of CO2 we're putting in the air, and it's just general pollution, you know. And I don't understand that, and that seems to me a very sensible solution that should be promoted, yet this administration stands in the way of that. And so to me, it just tells me that it's just the whole, getting back to the guy doesn't really know what he's doing, okay? You know, I probably enjoy partying more with Barack Obama than George Bush or even maybe Bill Clinton, but I just don't think that Barack Obama is anywhere near as smart as Bill Clinton. And for those of you who think George Bush was stupid, I did have the opportunity to meet him once and actually talk, or be in a forum where he was talking candidly with people, and he talks much differently when he's in a small group of people. He's very coherent, as opposed to when he gets in front of people. The guy is like as tongue-tied as you could possibly be. But you know, so I don't know whether he's all that stupid, and yet at the same time, I don't see why people think Obama is all that smart. They're all politicians. And if they really knew anything, they'd be running companies like Steve Jobs. That's all I have to say. But I think that, you know, even if Obama, forget about who the politician is, if the policies change, I think the market could rally. And I think on that basis, you could have a pretty decent and playable bull market. So enough with the pontificating here. Let's see how many emails I get telling me I'm a right-wing nutcase. But NetSuite, you know, pulls all the way back. It's a weaker, thinner stock to me. I don't really care for it. How about you, Dr. K?
No, I don't like that kind of action. There's a lot of heavy volume selling in the pattern. It's straight up, straight down. So that tells me there's going to be choppiness ahead.
Yeah, somebody says BWLD is a short. Nah, it's too thin. Trades what? A couple, 300 shares. I wouldn't short it. It's just in the base. It's underneath the 50-day, but it did get some volume support yesterday on a weak market day. I wouldn't short it just because it's too thin. I like this question. This is a good question, actually, I think. All the nauseating analysis of bases, I'm sure stock bases is what you mean, the chart patterns. Is it something that is worth it? Oh, definitely. I think so. Dr. K, your comment?
Yeah, that's essential. I mean, it's absolutely essential for technical analysis to be able to size up the health of a basing pattern. And I mean, I got a lot of training in doing that with O'Neill himself when we go through patterns, and I would recommend different stocks, and he would criticize the base, or he'd like the base, and I would learn from that. And it's very essential. I mean, that's fundamental to his technical analysis, is being able to size up a basing pattern.
Yeah, and I do believe that on a weekly chart, it's the best way to try and detect institutional accumulation, and that's really what you're always trying to do. So, you know, maybe on a daily chart, a lot of it is noise, but pocket pivots are very useful on daily charts. And then just being able to understand the patterns that occur in a weekly chart when institutions are steadily accumulating stock. So, yeah, it can get a little bit nauseating. It seems like a lot of it's just a bunch of baloney, but I think it does work, and I think it's worthwhile doing so. Somebody asked, do you have a favorite type of base breakout? I love any kind of base breakout that leads to a 100% price move. I don't discriminate. Yes, even somebody says here, O'Neill based his secular comment on a change in leadership in Washington more business friendly, and I agree with that 100%. Obama will be a great party planner and have a show on HGTV next year. It might be an interesting program. So, but you know, I just don't really, in terms of what the guy knows, I'd rather listen to Dr. K pontificate about any topic than Barack Obama. So,
yeah, same goes for me. But then that is also because Gil and I, we do share a lot of similar belief systems. So.
Yeah, we both drive a pickup truck with a hound dog and a shotgun in the back of the pickup truck. Oil companies are afraid, as well as the White House, are afraid of natural gas. Most natural gas is produced alongside crude oil, I believe. So I'm not necessarily sure. I don't think I think if oil companies can make money drilling for natural gas, they would do so. Anybody would. So I think that the White House just wants to control everybody. And somebody made a really good point the other day that if you want to see how tyrants approach the whole energy question, just look at a nighttime satellite image of North Korea and South Korea, and you can see that tyrants wish to deprive the populace of energy, and that's exactly what Obama is doing, at least according to this person. So I just think those guys don't get it. The transportation secretary the other day says that Lexus would have never started. Thanks to Obama, he's jump-started the hybrid business, and that Lexus now, who would have ever thought Lexus would ever come out with a hybrid model until now, thanks to Obama's policy? Well, the moron doesn't know that in 2005 is when Lexus came out with their first hybrid vehicle. But, like Al Gore, who invented the Internet, the transportation secretary wants to believe that Obama and his cabinet invented hybrid cars, or at least jump-started it. These politicians live in a fantasy world of their own making, all of them. Anyways, can I say this one? Mr. Ross and Dr. K, I just wanted to let you know you offer great services through VOSI. I've learned so much as a subscriber. You guys are appreciated from this webinoid from Pennsylvania. Thanks. We appreciate that. That's good to hear.
Yeah,
that
thanks.
makes up for all the bad, the emails calling us idiots.
Well,
my view is if I don't have at least a couple of people call me an idiot, I'm not doing my job.
I only see one or two. Well, the one or two I see seem to be the one-offs. The exceptions.
Yeah. Oh, okay. I'm not sure. Somebody had the stuff about bases, first stage versus fourth stage. Somebody was talking about all the nauseating analysis about bases in terms of them being first stage or fourth stage. We don't pay attention to that ourselves. Correct, Dr. K?
Right. There's far more important variables than what stage the base is in.
Yeah. Okay, here's an interesting question. What makes Mellanox a better buy than N based on the chart? The fact that Mellanox trades a little more volume, the fact that it has, I think, better earnings. 74 cents are expecting next quarter, up 174%, so that's a big acceleration from 112% in the last quarter, and you have 179 mutual funds owning 15 million shares. And on the other hand, next quarter, 4 cents a share, up 100%. Okay, sales up 30%, and you have it's fairly well owned. I have to admit that. But if you like N and you think it can bounce off this level, then you would buy it. And I would say you don't have to listen to me, but the only thing you have to listen to is how you might handle the stock, which is if you got the 50-day moving average on N. Okay, right here, it's right there. So if you bought a stock and it can't hold a 50-day, 47.62, a whopping $1 lower from where it's trading right now, roughly, then you have a good reference point to come into the stock. So that you can buy it. You don't have to. If you're asking us for our opinion on a stock, you don't have to listen to what we have to say. Fade us. Maybe that works better. Do pocket pivots take the base stage into account?
And also has it keeps violating the 50 days, so it's a sloppier pattern. It also doesn't have this massive viable gap up that Mellanox had back in April. The Mellanox pattern is just it's just a tighter, healthier pattern with a lot more upside momentum.
More powerful. Yeah. Somebody said Obama is a great president for France. Maybe, I don't know. All right, let's pick on Obama. Let's pick on somebody else. Let's pick on Dr. K. Dr. K, what stocks do you like? What's the matter? You guys don't like the ones I like and bought this morning? Fine.
Yeah, this kind of market environment, there's not a whole lot. Mellanox has been good, but then there's some retailers out there. Let me see here, because I've still got on my watch list a bunch of retailers that are.
Okay, go ahead and look through those real quick.
Not been holding up, interestingly, and they're actually about to be removed from my list, like ZUMZ. Look at GNC is having some trouble there.
Yeah.
There were some biotechs that were looking decent in this pullback. ALGN was looking decent, but now that's breaking its 50-day. You know, again, there's a lot. The model was seeing that a lot of these names that had been holding up fairly well were not holding up very well, and that, you know, that's a big consideration in terms of going to a sell signal.
Let's see. We've gone for over an hour now. I want to cover some of these last questions real quickly. Somebody says, "No, you two are never idiots." Oh yeah, you haven't talked to my wife. I've learned more from you in the last 1.5 years than at any other time. That's good to know. I'm glad to know at least we're doing our job in some cases. Somebody said, now here's something. Gail and Dr. K, my opinion is that the markets are going to continue down, forcing the Feds into QE next. Well, the MDM is on a sell signal, so I guess right now it's confirming it, but I don't know. I bought a bunch of stocks this morning, and they're up, and the market's not really blowing apart. I think that's just an opinion, so just keep in mind that is just your opinion. And don't let that sway you into doing the wrong thing at the wrong time based on your opinion. Watch the market and forget about what you think the market should be doing. There's one of the things that I think Michael Covel points out in one of his books is that you need to get out of this idea of looking at the market in terms of what you think it should be doing and be able to clear your head in order to clearly see what the market is doing. And I think that's the key. So, you know, I could argue with people about different scenarios all day long. I'm going to tell you 2 out of 3 scenarios I come up with are usually wrong, so you just got to watch the market. Other people concur. Okay. Somebody read our book 30 times? I don't think I've read it since we wrote it. I hate to look back at books I've written because a lot of times you just go back and you think you want to redo the whole thing. So let me run through. Let's just close up with a few questions or a few of these stocks that people have mentioned. TripAdvisor pulled back to the 50-day. Nothing really there. Not heavy volume either. Expedia in the same group, not holding the 50-day and breaking. But you know, if you're using the 50-day as your guide on the stock, if it closes below the 50-day, then of course you know what a violation would be, a move below the intraday low of today if it closes below the 50-day. So you can see on a relative basis, Trip is acting better. Web.com is one we've liked before. It's down to the 50-day. So here you go down to the 50-day. You know, a lot of times in a market like this, and I've noticed this over the last maybe couple of years, a lot of these leading stocks, they have a hairy pullback back to the 50-day, and you might be too scared to buy them. A lot of times they hold. Like here, this one holds back here on this pullback and finds support just before the break. And now in this pullback, you're right at it. So, you know, it could be viable here, but you got a good reference for a stop, which would be a violation of the 50-day.
Yeah,
TCBI.
and that's why the 7-week rule is based on the violation of the 50-day, because if you wait for a violation of the 50-day, sometimes the stock won't violate the 50-day until, you know, weeks to months later, and you get a nice gain in it.
TCBI is a Texas Capital Bank. It's acting okay. You know, nothing really to say there, but notice it is held up better. So I think, you know, the advantage of the sell-off of the last 4 or 5 days, if you're looking at long ideas and building your watch list or even looking to act on things, is what has acted the best and what has held up the best and what has really kind of come apart that you don't really want to be buying into. So this Acorn thing, you know, you had a pocket pivot here the other day and it's holding the 10-day moving average, no violation. So it's still okay on that basis. Fran, you know, I was talking with Ross Haber the other day and we were debating Fran. He likes Fran. I don't like Fran. It's a little bit loosey-goosey there for me. And this base, I don't really like this base. It's kind of a deep cut. It needs more time to set up, but, you know, just keep an eye on it if you like it. SWHC, what is that one? Smith & Wesson. Oh, yeah. Well, it's, you know, holding the 10-day. Not much, you know, after this sharp move, a Bible gap up here. Whoops,
really thin, though.
It's a really thin stock. Yeah, well, it's relatively. Yeah, I mean, so it's holding up. It's not one I would play, though. Too thin. Okay, let's run through these, and I think that's all we got here. Oh, one other one people asked about is OSUR. Moves up, breaks out. It's another thin stock holding the 10-day moving average. So depending on what you're using as a trailing stop on this, it's acting okay. Comes down pretty hard, but it's a thin stock. So, but if it's holding the breakout, it looks like it's okay. On the weekly chart, that's what it looks like. So you see the breakout. Uh-oh, there's your fire alarm again, Dr. K.
Yeah, I don't know what's going on.
That's a great sound effect, you know. We should have that going off when the market starts to tank. That would be great. That would scare people out of their positions.
Yeah.
So that looks okay. You know, so just to sum up real quickly, we've gone for an hour and 10 minutes today, but probably a good day to do that. My view is that you're in a choppy market, and whether we break down or not by the end of the day remains to be seen, and head lower. So, and again, we're in this trend channel. You're at the low, so I'd like to see it hold. You could pull back to the 10 today. We'll just have to see how it pans out. Also, it's a bifurcated market in the sense that, you know, some of these stocks have broken down. But notice how they're trying to rally back. You know, VMware was down earlier, now it's turning around. CMG, you know, it got close to the 200-day moving average. You may notice if you're looking at a weekly chart on CMG, it actually did touch the 40-week, and a lot of times the 40-week on the weekly is where they'll bounce too. Okay. The Baidu continues to act weak, but I think a lot of these stocks have come down for a while, so the need to sell is obvious. And I think at worst, you're probably in a choppy environment. We'll see how the MDM works out. So far, the signal is working right now, and I don't want to prejudge it or come to any conclusions. I think you just stay with it until your stop is hit or until the MDM gives you a different signal. And that's pretty much it. That's all I've got. Anything else, Dr. K?
I think we're good.
All right, you guys, good luck. Hope it's been helpful today, and we'll catch you guys next time. All right, take care.